in this final element, in this final video for our module on financial statements, we're going to take a look at the concepts of book value versus market value as they have to do with the firm's capital components. While we're doing that, we'll consider the formation of something referred to as enterprise value, and then we'll go ahead finally and look at a consolidated financial statement, which is and then we'll look at a consolidated financial statement, which will be the balance sheet and the income statement augmented by some market value construction for the company. So when we think about book value and market value, we're really talking in this case about items that are coming off of the balance sheet that have to do with the company's capital construction, or the value based on book compared to market of the capital. When we look at book and market values in this respect, we're talking about a book value versus a market value way of looking at the company's capital components. The common stock that the company has extended or placed, the preferred stock that the company has outstanding, the debt that the company has taken on, which means companies or individuals have loaned money to the company for various purposes. Together, these create the market capitalization of the company, or the capital structure of the company. So let's consider the book value construction of this. These pieces that I'm looking at right here have come directly from the company's balance sheet. And here we have 2013, as you'll recall, and here we have 2014. And first we're looking at the company's debt. Well, the first item we'll look at, and we'll constrain our view here to 2014, the first item we're going to look at is are the mortgages that the company has. In this case, the company has $285,300 in mortgages. These are interest-only mortgages, and you can see that the company had increased its mortgage balances, or the amount of money it borrowed through mortgages, from 2013 to 14, just as it has some of the other elements here as well. Similarly, the company has $700,015 in outstanding bonds. This is the money that the company received from bondholders when bondholders bought the company's bonds. So when they invested, just like this is the dollar amount that the company probably borrowed from banks in the case, just as this is the money the company borrowed from banks via mortgages. And since it's interest only, we know they haven't paid off any principal, or they likely haven't paid off any principal yet. So the book value would be what these companies are owed, or what these entities are owed when this company pays them back. And the total of that for this company is $985,315. Well, in the terms of common stock, it's also what the company raised when they received money from shareholders that the company initially sold stock to. So this is money the company got. This has nothing to do with one investor in the market selling their shares of stock to another investor in the market. This is exclusive to when the company sold stock in the company to investors in the market and received that money. This is often referred to as paid-in capital or paid-in surplus. It's money that was paid into the company so that the company could use it as part of its capital structure. And in this case, we have common stock and we have preferred stock. But we also have accumulated earnings here. But we also have accumulated retained earnings here. And accumulated retained earnings are going to be the monies that the company reinvested in itself. Remember, these monies, retained earnings, have come from net income. In fact, retained earnings are the net income that the company didn't distribute to the stakeholders of the company in dividends. So this is really money that belongs to the shareholders, the stakeholders, that have reinvested it into the company. And in this case, the total of common stock, preferred stock, and accumulated retained earnings, all on a book basis, are $1,959,504. We can look now at some information we can look now at some information that doesn't come from the balance sheet. This is additional financial information, and you'll see that this information is exclusively market-oriented. So we'll transition from looking at book value basis to market value basis. However, saying that, notice, once again, 2013 and 2014, respectively for these columns, notice that the mortgage balances or mortgage values on a market value basis are the same numbers as they were on a book value basis. That's because we don't have any good metric that helps us transition from book to market value for a mortgage, especially an interest-only mortgage. So when we're thinking about the market value of a mortgage, a credit line, a note receivable, etc., so when we think about the market value of a mortgage, a credit line, a note payable, etc., we think about these as being proxies. So when we think about the market value of a mortgage, the market value of a note payable, the market value of some credit line, we're going to use the book value as proxy for that because we don't have any other good instrument, any other good metric to help us make that transition from book to market value. However, in the case of the company's bonds, which again are part of its long-term debt construction, part of its capital structure, we clearly have a mechanism to help us do this. And you'll remember this, the market value of a company's bond is equal to C times 1 minus 1 divided by 1 plus YTM to the power of N divided by YTM plus F divided by 1 plus YTM to the power of N. And you'll recall this from some of the other discussions on the time value of money that we've had, where C is simply a payment. It's the payment that the bond holder is receiving. YTM is the current rate or current yield for this type of debt or investment in the market today, which is probably a different rate than the payment is based on. And if the payment is coming more than once a year, let's say it comes twice a year, as it does for most bondholders, then the yield or the YTM in the market today must be divided by 2. N is the number of years that the bond has to maturity times the number of times it pays per year. F is the face value, typically $1,000 for bonds. And then we can create this valuation, and it gives us the market value per bond. We'll notice here that we have a coupon rate of 5% for the bonds that are outstanding. We have a current yield in the market today of 4.25%, and that each bond is worth $1,117.34. That's because as the interest rates go down after bonds are issued, the bond value goes up. Were the interest rates to have gone up, the bond value would have gone down. So in this case, we do have a good, solid metric that we can use to transition from a book value to a market value for the bonds, such that we're no longer using the book value of the bonds. We're now using the market value of the bonds, which is the number of bonds outstanding times the dollar amount per bond outstanding. When we come over here and take a look at the equity components, the equity components now are going to be the common stock value and the preferred stock value. We have in this case 59,858 shares of common stock outstanding at a current market price of $31.50, giving us a total market cap or market value for the common stock of $1,885,529. We have 20,000 shares of preferred stock outstanding at $17.75 a share, so it gives us a total of $355,000 in the market value or market cap of the preferred stock, and together those two equal $2,240,529. So book versus market value. These help us consider something referred to as enterprise value. think of enterprise value as being the valuation of the company. If you've ever watched Shark Tank, you'll see Kevin O'Leary or Mark Cuban talk about valuations. They're talking about the enterprise value of the company. And as it turns out, we sometimes look at the enterprise value from a book value perspective and from a market value perspective. But even the book value perspective is a little bit fuzzy, because when we define the book value perspective, we start with the market value of the equity. So we start with the market values of these equity components rather than the book value of them, So the enterprise value from a book value perspective is the market value of the equity plus the book value of all the liabilities. Well, that would include all the long-term debt and the current liabilities. And then we subtract cash from that. Remember that cash is part of current assets. That might be helpful as we look at some numbers here in a few moments. So this is the book value perspective of enterprise value. The market value perspective of enterprise value also uses the same market cap of the equity, so that's the market value of the common stock outstanding, plus the market value of the preferred stock outstanding, if there is preferred stock, plus the market value of the long-term debt. Not the market value of long-term debt and current liabilities, just the long-term debt. And again, for the market value of long-term debt elements where we don't have a good metric to transition from book value to market value, we will use book value as proxy for market value, such as in mortgages, notes payable, credit lines, etc. So now let's look at some numbers. I've gone ahead and separated these elements out such that we have the book value construction of enterprise value separate from the market value construction of enterprise value. We see that we're using the same dollar value for the common stock and the preferred stock as we would for, we see that we're using the same value for common and preferred for both the book and the market perspectives. That's because we have the same criteria to use the market cap for each one. We added those up. We then, for the book value, take the current liabilities plus the book value of the mortgage, the book value of the bonds. We add those up, subtract cash, and we come up with $3,308,982. When we do this same construction for market value, we've used the market value, the market cap of the common stock and preferred. We came up with the same total equity number from the company's capital components, but we're not including now current liabilities because we don't do that within this construction. We only look at the long-term debt. We're using the book value as proxy for market value of the mortgages. We're using the market value of the bonds, gives us a new number, but now we're not subtracting cash. And interestingly enough, we come up with a number very similar, just within $1,000 or so, of the book value. That's not uncommon, by the way. Current liabilities are offset largely by cash. Think back to the quick and current ratios that you may have learned in the beginnings of Finance 300 or that you might learn in some other finance course. So in this case, we see that using the market value of these instruments, but without taking some of the short-term elements into account, gives us a value very similar to the book value construction of enterprise value. Well, finally, let's look at a consolidated statement of these three elements for this sample company, where we have the balance sheet, the income statement, and then finally this additional financial information. Now, you won't always see additional financial information on a consolidated set of financial statements. I presented them here to you because together the balance sheet, the income statement, this additional market information give us a tremendously rich set of tools for managers of companies to use to help manage the operation, to help drive optimal value for the operation, to help create the greatest return for shareholders, of which the managers probably are part.